Now let's take up 8-7, P 8-7, Materials and Labor Variances Analysis. Now the requirements of the problem, number 1, calculate equivalent production for materials, labor, and overhead. Be sure to refer to the standard cost summary to help determine the percentage of materials in ending work in process. So we are now given the standard cost summary on page 472, and the standards for materials. We have 2 gallons of liquid lead at $2. So the standard cost per unit is $4. Then we have 2 gallons of varnish at $3. So it's $6 per unit. Standard cost of materials per unit is $10. Then for labor, uh, 1 unit requires 1 hour at $12, and factory overhead $1 per direct labor hour. The standard unit cost is $23. For production and cost summary, units completed during the month 9,000, ending units in process 1/4 completed 2,000, gallons of liquid lead used 21,000, gallons of varnish used 20,000. Then we have the continuation of production and cost summary. Direct labor hours worked 10,000. Cost of liquid lead used $41,160. Cost of varnish used $60,000. Cost of direct labor $117,000. 1 gallon each of liquid lead and varnish are added at the start of processing. The balance of the materials added when the process is 2/3 complete. Labor and overhead are added evenly throughout the process. There were no units in process at the beginning of the month. So we now begin with requirement number 1, the equivalent production for materials we have now completed during the month is 9,000 units. Then we have the ending work in process 2,000, and we have the total of 10,000 units. We have now your uh, labor and overhead completed during the month 9,000, and the equivalent units and ending work in process. This stage of work done generally is 1/4, so you get 500. Now with regards to materials, you have now your 1 gallon of liquid lead and varnish are added at the start of processing. The balance of the materials added when the process is 2/3 complete. Now, in other words, at the beginning of the process, you add 1/2 of the needed materials, while the other half will be added when the process is 2/3 completed. Now, with regards to the ending inventory of 2,000 units, the materials added was only 1/2 of the needed materials, since the ending units in process is only 1/4 completed. So meaning you still need to add the remaining 50% materials when the process is already 2/3 complete. But for labor and overhead, equivalent units for the work in process end is 500. So your EP for materials is 10,000, but for labor and overhead is only 9,500. Now, second requirement, calculate materials and labor variances and indicate whether they are favorable or unfavorable using the diagram format shown in figure 8-4. So for the liquid lead, we have the actual cost. The actual cost is 21,000 gallons of liquid lead used. So we have now the unit cost of 1.96, no? So we have the computation of 1.96 at here. 41,160 divided by 21,000 gallons. So actually you are given the amount of 41,160. That's the cost of liquid lead use. And we divide that by 21,000 gallons. That gives us 1.96. And the actual quantity times the standard price, 21,000 gallons at 2. The first column, the actual cost, that involves the actual gallons times the actual unit cost. So you now get your an amount of the actual cost. For here, we have the actual quantity times standard price. So you get now the standard price, which is given at $2 per gallon. So the result of $42,000. Then for the standard quantity multiplied by the standard price, we have the standard quantity for 10,000 units. You multiply by 2 gallons per unit, the standard material needed for the product for liquid lead. So you now get the 10,000 units being your equivalent production of the liquid lead multiplied by 2 gallons per unit. So you now get 20,000 multiplied by 2, you get total of 40,000. So the material price variance is the difference between 42,000 and 41,160. Now it's due to the unit price factor, the difference between $2 and 1.96 is $4 multiplied by 21,000. So that's 840. For the material quantity variance, we have the difference between, here we have the actual quantity times standard price and the standard quantity times standard price. So the difference in quantities actually is 21,000 minus 20,000. So it's 1,000 multiplied by $2, giving the material quantity variance equal to 2,000. That's unfavorable. So the net liquid lead variance is the sum of here 840, or the difference, and 2,000. 840 is favorable, 2,000 is unfavorable. So the net liquid lead variance of 1,160 is unfavorable. Now we go to requirement number 3. We have to determine the cost of materials and labor in the work in process account at the end of the month. So we have now the material varnish for the actual cost of 20,000 gallons times 3. So that gives us 60,000. Then we have actual quantity, standard price of 20,000 gallons. That's the gallons of varnish used. Then multiply it by 3. being the standard price given. So you get 120,000. Then for standard hours times standard rate, standard hours of 4 hour equivalent production. So we now get 9,500 units. Standard hour per unit is 1 hour. So we get the standard rate equivalent to 12. That's 1 hour times 12. So we get 12. Now take note that we have now the labor cost applicable. While above we have the varnish. Here we have for varnish, we have 60,000 divided by 20,000 gallons. 60,000 is given cost of varnish used. Then we divide by 20,000 gallons. So you get now the cost per gallon of varnish equal to 3. So the actual cost 60,000, the same as the standard cost of 60,000. In other words, there is no material price variance for varnish, whereas the material quantity variance is still zero because your actual quantity of varnish is 20,000. The standard is also 20,000. So material quantity variance is zero. Now, for labor, we have the actual cost of labor, 10,000 hours. Here multiplied by 111.70, taken by 117,000 because of direct labor divide by 10,000 hours. So we now get 11.70, the actual cost of labor of 117,000. Actual hours multiplied by standard rate of 12, so you get 120,000. For the standard hours multiplied by the standard rate, we have 9,500 units multiplied by 1 hour per unit, that's standard rate. So we multiply by 12, so $12 good for 1 unit. 1 unit needs 1 hour at 12, so we get 114,000. The labor rate variance is 120,000 minus 117,000. The labor rate variance is favorable because we now have the standard rate higher than the actual rate. Then for the labor efficiency variance, it's unfavorable because our actual hour is greater than the standard hour. So again, we get the net labor variance equal to 3,000. It's unfavorable because 6,000 is greater and it's unfavorable. Now, finally, the last requirement, determine the cost of materials, labor, and in the work in process account at the end of the month. So for we have now ending work in process, 2,000 units given is 2,000 units, one half complete as two materials. So we still need to add the remaining one half times one half times 10. That's the labor rate. Then for the 2,000 units, one-fourth complete as to labor. We now multiply 2,000 units times one-fourth and then multiply by 12. That's now your labor rate. Well, the material rate is 10. So we get the materials and labor cost in work in process at the end of the month equal to $16,000. Next, we go to problem number 8. Problem number 8 has two requirements. One, journal entries to record the material transactions, assuming that the material price variance was recorded at the time of purchase. Make journal entries to record the labor variances. So we now have the standard cost per unit materials 5.5 pounds at 220 per pound, so you get 12.10. Then labor 1.8 hours times point or $10 per hour. So we have one unit would need labor cost of $18. Although 10,000 units were budgeted, only 8,800 units were produced. The purchasing department bought 55,000 pounds of materials at a cost of 123,750. Actual pounds of materials used were 54,305. Direct labor cost was 186,550 for 18,200 hours worked. So we have now the journal entries. First, we debit to raw materials inventory multiplying 55,000 by 2.20. Now, 55,000 is the number of pounds of materials bought by the purchasing department. So, 55,000 at standard is 2.20. So, we now get the standard price equal to 121,000. We have a material purchase price variance equal to 5 cents times 55,000. The actual cost of materials 123,750. That's the actual cost of materials. Then we have to divide by 55,000 pounds. So per pound, we get 2.25. 2.25, that's the actual unit price. Standard unit price is 2.20 per pound. So the difference is 5 cents. Next entry, we debit to work in process 8,800 units manufactured. Then we multiply by 5.5 pounds. Here, 5.5 pounds for the amount of 220. And 220 again is standard amount. So we have the debit to work in process at standard equal to 158,400. Then we also debit to labor efficiency variance at 2,360 hours taken here, 18,200. Then 18,200 we deduct 8,800, that's standard, multiplied by 1.8 hour. We have the standard hours per unit. So we now get 1.8 hour times 10, the debit to work in process. Okay? So we have first, we have debit to work in process at standard. Here is 8,800 times 5.5 pounds. That's standard for materials. Now, but we have a debit to materials quantity variance. For the quantity used is given at 54,305 minus standard of 48,400 taken by multiplying 8,800 units by 5.5 pounds. So you get 12,991 after multiplying it by 2.20, which is the standard price per pound of the materials. So we now get 158,400. Here, 106,480. Then we debit to materials quantity variance, 54,305 minus 48,400 computed as this, and we multiply by 2.20 being the standard price per pound of materials. So we have now the quantity variance. It's unfavorable. That's why we debit. It's unfavorable because the actual pounds is greater than the standard pounds. So again, we multiply and we have 2.20 for the credit to raw materials inventory. Now we are crediting raw materials inventory for the actual 54,305 and the actual pounds used here, and we have the actual cost. Uh, so we have now 119,471. For entry number 2, we debit 2 work in process for 8,800 units. That's the actual production. You multiply by the standard hour per unit times 10. That's your standard rate per hour. So we get 23 600 for the labor efficiency variance given us 2,360. We have now 2,360 hours multiplied by 10. 10 is the standard rate per hour. So you get the debit to work in process 158,400. Debit to labor efficiency variance for 23,600. Debit labor rate variance 18,200 multiplied by $25 per hour. Taken by first we have 186 550 divided by 18,200 hours, so we get $10 per hour. And we have the standard rate of $10 per hour, and we now get $25 per hour. So the debit to labor rate variance is at 20.25 cents per hour for 550. Then credit to payroll for the actual payroll of 186,550. Next, we go to problem 8-10. So far, this appears to be a very, very long problem. However, with regards to the solution, you can see it's not really very, very long. So let's take up the entries in accordance with the numbers. Here, calculate the following amount of material price variance to be prorated to finished goods inventory at December 31. Hint, you must first determine the percentage of direct materials cost in the ending finished goods inventory to total direct material cost. So you are now dealing with the operations of Costa Brava Manufacturing Company using a standard cost system that records raw materials at actual cost. So records raw materials at actual cost. records material price variances at the same time that raw materials are issued to work in process and prorates all variances at the end of the year. Variances associated with direct materials are prorated based on the direct materials balances in the appropriate accounts, and variances associated with direct labor are prorated based on direct labor balances in the appropriate accounts. So we have now the following information available at the end of the year. So we now have your requirement for number 10. First, we are required to calculate the amount of material price variance to be prorated to finished goods at December 31. Hint, you must first determine the percentage of direct materials cost in the ending finished goods inventory to total direct materials cost. Now, we have to determine direct material cost in finished goods inventory given at 87,000. That's in finished goods inventory and it's equivalent to 20%. If you divide it 7,000 by 20%, that will give you 435,000, equivalent of 100%. So the 80% of 435,000, that's your material cost in cost of goods sold. So we have now your material price variance given at here. It's unfavorable, the amount of 10,000. Percent of direct material cost in finished goods inventory is equal to 20%. So we now get the amount to be prorated to finished goods inventory equal to 2,000. Now it's stated here in the case of 8-10, hint, you must first determine the percentage of direct materials cost in the ending finished goods inventory to the total direct material cost. So we have the amount of the rate direct materials cost in finished goods inventory is 20%. So you now get your amount to be prorated to finished goods inventory. Now for the variance of 10,000. Second requirement, total amount of direct materials cost in the finished goods inventory at December 31. After all materials variances have been prorated. So use a percentage that you develop in number 1 above. So for number 2, the material price variance, it's negative, it's unfavorable. The materials quantity variance equal to a favorable variance of 15,000. So the net material cost variance is uh, 15,000 minus 10,000. So you get 5,000. We have now the percent of direct material cost in finished goods inventory of 20%. The net variance prorated to finished goods inventory is a credit balance of 1,000. Then direct material cost in finished goods inventory before variances are prorated is the amount of 87,000. It's a debit. So direct material cost in finished goods inventory before variances are prorated. Now, the total amount of direct material cost in finished goods inventory is equal to 86,000. Now, number 3, requirement, number 10, total amount direct labor cost in the finished goods inventory at December 31, after all labor variances have been assigned to here. You have a hint. Use the same approach as 1 and 2 above. And number 4, total cost of goods sold for the year ended December 31 after all variances have been prorated. So let's find out if in number 3, direct labor cost in finished goods inventory is 130,500 direct labor. We divide that by 15%. So we have the direct labor cost in cost of goods sold still equivalent to 85%. So you get it by assuming that your direct labor cost in finished goods is at 15%. So direct labor cost in finished goods for 130,500 in cost of goods sold equal to 739,500 is given, and we now assign a percentage of 85%. So we have the total of 870,000 for 100%. So the labor rate variance is negative of 20,000. It's unfavorable. Labor rate variance is 20,000 unfavorable inside the parentheses. Then we have labor efficiency variance. 5,000 is favorable. Okay, so we have now the net labor cost variance equal to the two amounts. So we now get the net labor cost variance equal to 15,000. It's unfavorable. Percent direct labor cost in finished goods inventory. We multiply by 15% as given above. So we now get 2,250 for uh, for the debit, and then we have direct labor costs in finished goods inventory before variances are prorated. So we have 130,500, which is debit. Okay, now total amount direct labor cost in finished goods is 132,750. Okay, that's for a requirement number 3 of 8-10. Now for requirement number 4, we are asked for total cost, determine the total cost of goods sold at year ended December 31 after all variances have been prorated. So we now have for 8-10 journal entries. Net labor cost variance is 15,000. It's a debit. Then percent of direct labor cost in cost of goods sold of 85 percent. So we now get the labor and cost variance prorated to cost of goods sold for 12,750. So we have now the total cost of goods sold equal to 1,167,850. Okay, so that's 8 dash 10. And we have now problem 8 dash 11. Compute each of the following items for AdSense for May. Show computations in good form. So number one, standard quantity of raw materials allowed in pounds for actual production. Actual quantity of raw materials used in pounds. Be sure to consider the materials quantity variance. And we have now your number three, standard direct labor hours allowed. Number four, actual direct labor hours worked. Hint, be sure to consider the direct labor efficiency variance. And five, actual direct labor rate. Hint, be sure to consider the direct labor rate variance. So for requirement number one of 8 dash 11, we have now to determine the standard quantity of raw materials allowed in pounds for actual production. So we have now the actual production of 4,000 units. Okay, now the actual production given for May, 4,000 units. Then standard materials per unit is 5 pounds as given. So we have now 5 pounds. So we multiply 5 to 4,000, we get the standard quantity of materials allowed equal to 20,000 pounds. Then number two, the actual quantity of materials used, the standard quantity of 20,000 pounds, and then we add back the unfavorable debit materials quantity variance divided by the standard price per pound. So we have now 1,000. That's your material quantity variance. It's unfavorable because it's on the debit side. Okay, unfavorable because it's on the debit side. So we have now 1,000 pounds. The actual quantity of materials used is 21,000 pounds. Now for number three, standard direct labor hours allowed. Actual production of 4,000 units. The standard hours per unit is $1. So 1 hour. So you get the standard hours allowed equivalent to 4,000 hours. Then for number four, actual direct labor hours worked. Be sure to consider the direct labor efficiency variance. So for number four, actual direct labor hours worked, standard hours allowed, 4,000 less favorable credit direct labor efficiency variance. Divide it by 8, no? 8 is standard rate. So 1,200 divided by 8 is equal to 150. That's your variance. So the actual hours work, if we deduct, is 3,850. Then number five, the actual direct labor rate after the variance. So the actual standard direct labor rate, $8. Then we add back the unfavorable debit direct labor rate variance, divide by the actual hours worked. So we have number of hours, 700, or we have the variance, no? For 770, it's a debit. Again, it's unfavorable. We divide it by 3,850, and we have to add this to your standard direct labor rate. So we now get 8.20. That's 8 dash 11. Then we go to 8 dash 13. Okay, 8 dash 13. What are the requirements of the problem in 8 dash 13? There are many requirements, so it appears to be a long problem. Okay, so we have now to focus on the journal entries of here we have 8 13. The standard cost production for October in 8 13 as given standard cost summary. Direct materials 24 yards at 0.55, direct labor 3 hours at 10, and factory overhead 3 hours times 2. So the standard cost per dozen is 49.20. So the basis of measuring the standard cost per dozen is 49.20. Okay, so we now use requirement number 1. Prepare a schedule computing the October total standard cost of last 30, 31, and 32. So we have now the cost summary as standard cost of production equal to 183,240 from lots 30, 31, and 32 units in lot. That's the number of dozens, 1,000, 1,700, and 1,200 given are the standard cost given the problem. So we have the standard cost equal to 49.20 for lot 30. So 49.20 for lot 31, and for lot 32 it's only 42. If you have now your standard material cost plus 80% to complete as to standard cost of labor and overhead. So we have now 13.20 as the standard material cost, and then we add 80% of 36. Now that's the sum of labor and factory overhead. So we now get 80% of 36. So going back to the standard cost of production equal to 183,240. Then the schedule computing material purchase price variance. Actual cost of materials purchased is given at 53,000 here. 53,200. That's the actual cost of materials bought. Actually, we have 53 or we have 53,200 as given. That's the actual cost. Then we deduct the standard cost of materials purchased by multiplying 95,000 yards, and the standard is 0.55 based on the problems. Then we have the standard cost of materials purchased 95,000, and you multiply by 0.55. Now the material price variance is 960. Again, it's unfavorable because it's debit. Okay, now for the third requirement, for each lot produced, prepare schedules computing So the first one of this is here. We are given in number 3, schedule of materials and labor variances. So materials quantity, we have the yards, the number of dozens in lot. So we have lot number 30 units given 1,000, 31 1,700, and 32 1,200. Then you have to multiply this by standard yards per dozen. It's equal to 24. We now get the total standard quantity equal to 24,000, lot 30, lot 31, 40,800, and lot 32 for, we multiply it by 24. So we get only 28,825. For the total standard quantity of 93,600, and the actual is 93,625. So we have now the requirement for number 3, letter A, but we are dealing only with materials quantity variance in yards for number 3. So the material quantity variances are now determined. We have the dozens in a lot for lot number 33, 1,000. For lot 31, it's 1,700, and again, for lot number 32, 1,200. We multiply by the standard yards per dozen. That's equal to 24 standard yards per dozen. It's now 24. Okay, given is 24 yards for direct materials. So we get total standard quantity per dozen. So the standard quantity per dozen. Then we have the actual yards used given of 24,100. And we determine the difference. 100 is unfavorable, and for lot 31, it's favorable because the standard quantity is with 28,800, whereas the variance leading to 28,825. So the total is 93,600 against uh, 93,365. There's a variance in yards equal to 235. Okay, so we now go to the continuation of problem 13 for the schedule 8-13 for labor efficiency variance. Okay, for here labor efficiency variance for lots 30, 31, and 32. We have the lots here for dozens in lots 1,000, 1,700, and 1,200. And we have now the standard hours per dozen equal to 3. So you have the standard hours per dozen equal to the total standard quantity. So we have me at lot 30, 3,000, lot 31, 5,100, and lot 32, 3,600. Then we multiply this by the percentage of completion. We now get the results for lot 30, 33,000 for lot 31. Okay, lot 31, we have 5,100. You multiply by 100%, so you now get 5,100. Now for the last group, lot 32, 1,200 times 1 times 3. So we are ending now with total standard quantity with the highest standard quantity under lot 31. Now for letter C, we'll deliberate variance. For letter C, prepare a schedule computing total flexible budget and production volume. Volume indicate whether favorable or unfavorable. So for number 3, letter B, and for letter C, determine the labor rate variance in dollars. So the uh, labor efficiency variance, don't forget the percentage of completion, and we have the labor rate variance in dollars. So for number 3 requirements, we have A, B, and C. Then for number 4, we have the schedule of overhead variances, the flexible budget variance, the actual overhead, 20 to 800, budget allowed for the level of production attained. So the fixed overhead is given at 288,000. We divide it by 12 and multiply by 60. So it's 14,400. The variable overhead good for 2,000. That's your uh, division is 12, or you can use 288 times or divided by 12 times 60. And the variable overhead is $2 times 40 cents times 10,980 for the variable overhead of 8,794. And for the variable component at 2 times the amount of 8,784 total budgeted overhead. For flexible budget, we have a favorable variance equal to 384. Next, we have the production volume variance, budgeted overhead for level of production attained, 23,184. Then the overhead applied to production is equal to the production volume variance. We have above. The variance here above is the budget overhead for level of production attained is 23,184, and here overhead applied to production 10,980 divided by 2. So you get the amount of 21 here 960. Now the standard overhead rate is computed. The last here in number 5, give some reasons as to why the production volume variance may be unfavorable and why it is important to correct the situation. The production volume variance was unfavorable. So that's why that the owner gives production volume here. Okay, the production volume variance was unfavorable because standard monthly production was $41,000. So we now get the $48,000 divided by 12. And the actual monthly production was 3,600. And shirts 1,000 plus 1,700 plus multiply 1,200 by 2. Okay, so we get $2 here. And the reduced production may have resulted from sales not being as high as forecasted, labor inefficiencies, or machine breakdowns due to faulty. Okay, so we have now problem 814. We now go to problem 8-15 or 814. We have the variances for materials, labor, and we have the net amounts. Okay, so we have now the material price variance, and to follow is the actual gallons times the standard price. Standard gallons times standard price. Okay, so we have for the material price variance. We have 814.86. For material quantity variance, it's 201.20. Okay, now the net variance will be taken by adding. Okay, net material price variance of 814.86, while for material quantity variance is 201.20. Okay, so we now get the labor variances. Okay, so the labor rate variance. Okay, the labor rate variance 19 to 90. It's unfavorable, while the labor efficiency variance is favorable. So you get the net variance there at 15,266. Okay, now we go to 8 plus the next problem. 8 plus 14. But you know that factory overhead variances can also be determined as long as you know the formula. So the actual factory overhead is the sum of variable and fixed. And we have 67,080 in problem 14. So we have now your actual factory overhead taken by adding variable plus fixed plus the amount of 60,500 to be used as divisor. So if you divide the amount of 127,850 and we deduct whatever deductions allowed, the budget shows a flexible budget variance of 1,184. Still, it is unfavorable. taken by deducting from 127,580, you deduct 126,896. Now we have your 503 batches with 50 hours. We have the difference. Okay, so for 503 batches at 60 hours, we are now using 30,104, 180 hours. Okay, so we have requirement 8-14. Okay, then after 8-14, we have another very long problem. Okay, so it does for 15 requirements of 8-15. Journal entries record the production of the units in both departments, and the movement of the goods and the sale of the goods. Use the two variance method for overhead variances analysis. You must first compute equivalent units in the variances for materials, labor, and factory overhead. So let's now go to 8-15, debit to work in process, mixing department at standard. We have now 1,100 units times 2 pounds times 2. So where is your 1,100 units? Debit to work in process. Now your standard material requirement per unit is 2 pounds. Okay, 2 pounds, and then we multiply it by the rate of 2. So we now get the amount of 4,400 at standard. Then the materials quantity variance is 200. Okay, that's material quantity variance. Then we have your material price variance. Again, you need 115. That's 115. And then credit to materials 4,715. We now go to work in process for blending. We have 950 times 2 times 1, 1,900. And then we have to credit the individual accounts. So we now credit to materials at actual cost. Material price variance is 7. Third 7 positive your material quantity variance. So the second entry, which will be considered also as uh, the rate, no? So factory overhead, we have for 1,000 plus 500 credit to materials. Then we have now debit to work in process for the mixing 1,000 units, 1,100 times 10, okay, times 2 hours. So we get actually the standard price of 22,000. Then the labor rate variance for the mixing is 430. That's another amount to be computed. Labor efficiency variance mixing 500, and the amount of credit to payroll equal to 500 here for the labor efficiency variance and the credit to payroll. Okay, next we have the to work in process. In the blending, we use the equivalent production 950 units times 1 hour times 12. Then the labor efficiency variance in the blending equal to 600 computed down. Then credit to labor rate variance blending and credit to payroll. Factory overhead is debited for 2,300 and credit to payroll. Next, we have to debit to work in process in the mixing for 1,100 units at 6. So we have 6,600 debit to factory overhead, flexible budget variance in the mixing for 500 and credit factory overhead for the production volume variance in the mixing and credit to factory overhead. Then here we have to debit work in process blending 950 times 4, 950 is equivalent unit of production. Debit factory overhead for the production volume variance in the blending. And we have factory overhead credit, flexible budget variance in the blending, and credit to factory overhead in the blending. Next, debit to factory overhead, 4,400 divided or plus 2,250. Then credit to various credits. Next, debit factory overhead mixing, debit factory overhead blending, and credit to factory overhead. Then still we debit to work in process the blending, credit work in process mixing. Finally, debit to finished goods, credit to work in process, debit to accounts receivable for the units sold at 60 and credit to sales. Then we have to debit cost goods sold at unit cost of 48, credit back to finished goods. Okay, we have now the last here for variances in the mixing. We have the material price variance. Again, we have the actual cost, and we compare with the actual quantity times standard price. Standard price of materials is in the mixing department at 2 per pound. So 4,600. So the material price variance 115 is unfavorable. For the material quantity variance is 200 unfavorable. So you get the net material variance 315 unfavorable. The equivalent units in mixing is 1,000 plus 200 times 1 half. Then we go to the blending. Again, the blending, the material price variance is 37 favorable, taken by comparing 1850 by 1813. So there's a difference of 37 is favorable because the standard price is greater than the actual price. For the material quantity variance is 50 is favorable, comparing the standard cost 1,900, which is higher than the actual quantity times standard price. So adding 50 and 37, you get 87. Now for labor in the mixing, again, we have the labor rate variance and the labor efficiency variance for the net amount of 430 unfavorable and 500 favorable. So there's a favorable net labor variance of 70. Then we have for the blending, again we have the labor rate variance and the labor efficiency. For factory overhead in the mixing, we have the actual overhead 6,700. We have the budgeted overhead at standard hours. So for the fix is 1,000 hours times 1 hour, 1,000 units times 1 hour times 2. So we have now 4,000 for the variable, 1,100 times 1 hour times 1. Now these data are given. Then for the budget overhead standard hours, we now get 6,200, and we compare that with the actual of 6,700. So we get a flexible budget variance equal to the amount of 500. It's unfavorable because the budget overhead standard hours is lower than the actual, meaning actual is higher. Then standard cost, 1,100 times 2 hours times 3 is 6,600. The production volume variance is 400 favorable. In the blending, we have the actual, and then we have now the budget at standard hours. So we get the flexible budget. Compare 3,850 by 3,750. Unfavorable, but it's a negative variance. Here, the standard cost is 3,800. Now the production volume variance is 50. It's unfavorable because budget standard hours is actually 3,850, but the standard is only 3,800. So we now get the net factory overhead variance. And finally, for the mixing, 200 units times 1/2, materials 400, labor is only 200 times here, 1/2 times 20, so 2,000. The same with labor and overhead. Okay, so we have now your solutions to 8-15. Actually, 8-15 is the review of the whole chapter. And another problem here is 8-16 with only two requirements. For 8-16, we have calculate the factory overhead, variable spending, variable efficiency, fixed spending, and production volume variances. So for the factory overhead, first we determine the variables. We have the actual variable overhead for 33,710. Then the actual hours times standard rate. The actual hours at 18,375. Now that's for given direct labor. We multiply that by the standard rate of 2. So variable cost, 5 hours at $2 per hour. So we now get 36,750. So if we compare 36,750 with 33,710, there's a difference of 3,040. That's the variable spending. Now we go to the variable efficiency taken by comparing actual hours times standard rate and then standard hours times standard rate. We get the difference of 1,750. That's the variable efficiency variance. Now, on the other hand, for the fixed cost, factory overhead, we have the fixed cost, and then we deduct the actual fixed overhead and the budgeted fixed cost, standard hours times standard rate. So first, we have 61,950 minus 60,000. That's the fixed overhead. So we now get 1,950 at the given level. Production volume total is 3,500 times 5 times 4. Okay, so you get 70,000. So the variance is 1,950 and 10,000. Okay, next we have the net factory overhead variance, variable spending. Okay. Okay, so we have now the net factory overhead variance of 9,340. There are two positive and two unfavorable. So you have to get the net variance, which is favorable, representing over applied factory overhead. Okay, that ends the lecture.